Okay, this is the video solution to Bailey and Ben, which is in chapter 12, and what we're looking at is the difference between variable costing and absorption costing. And this is a nice problem because it doesn't have a bunch of extra stuff in it. All right, it's includes all the basics, but you get to see what the relationships are. So they're preparing a current year statement, and we've got this information. And notice again that we've got budgeted variable manufacturing costs. So that would include direct material, direct labor, and variable overhead. Okay, not variable selling, because these are variable manufacturing costs, but all of our direct and then variable indirect costs like overhead would be in here. And then budgeted variable operating costs. So up here we're connected to sales. Okay, these are manufacturing costs. Now down here we're below the contribution margin, we're below gross margin. These are operating costs. Okay, they give us a budgeted fixed overhead, budgeted fixed operating costs. Okay, two big fixed costs that are planned. Budgeted production was 60,000 units. Our selling price was budgeted selling price is $550. Here's our actual volume and actual production. Okay, and they tell us that we've got 5,000 units in beginning inventory, and they carried the same standard costs as this year's production. Okay, so the first question is calculate the cost per unit that they would capitalize into inventory using variable costing and absorption costing. Okay, so that's a great example for you. So we'll start out over here on the solution here. Our variable cost per unit, they told us it was $1.50 per unit, so that would be the variable cost per unit right there, the $1.50. Okay, and then to make it absorption costing, we've got to add a fixed manufacturing cost component. So our fixed manufacturing overhead is sorry, $18,000 I've got. Where's the 18,000? Okay, here's our budgeted fixed overhead, sorry, 18,000, and we would divide that by our budgeted production, so it's budget over budget, right? That gives us our rate, 60,000, so that's 30 cents per unit. Okay, so don't ignore this little piece right here right now. So it's 30 cents, so under absorption costing, our fully absorbed cost per unit is $1.80 per unit. Okay? So under variable, it's just variable cost of $150. Under absorption, it's the variable cost plus the fixed cost component, or $1.80. Okay? Now the next question is determine if there would be a fixed MOH volume variance under either method. Remember that variable costing expenses all of the fixed overhead. It expenses it in full every year. So you never have a volume variance. Okay, and under absorption costing, it's the difference between the units that we planned and what we actually produced. Okay, so we planned on 60,000 units. Okay, that's what this plan is right here. That's what we budgeted, was 60,000. Our actual production was 58,000 units. So we didn't get as much through with our fixed overhead that we planned on. We're 2,000 units short. Okay, which means we didn't utilize that fixed overhead as much as we thought we would. So 2,000 units at 30 cents a piece, that's $600, and that would be an unfavorable variance. All right, then the next one, prepare a current year income statement in good form using variable costing. I just want you to know that when you see me with calculations like this, I don't do this for my health. I'm not doing it just for you to explain where a number came from. This is good problem-taking technique. Okay, you'll catch mistakes this way. It'll keep you wired into the numbers. It's just a really good idea. So we sold, our actual volume was 61,000 units, and our selling price, actual selling price, was $550 per unit. And they give us our budgeted selling price. Yeah, these are going in at standard, I guess. Yeah, budgeted selling price is $550 per unit. Yeah. So I've got $335,500 in sales. Variable manufacturing, 61,000 actual units at $1.50 for variable cost per unit, and variable operating expense, 61,000 times 50 cents per unit, or 30,500. Now remember that a variable cost statement is organized by cost behavior. So these are all of the variable costs up above the contribution margin. Okay, all right, so they're organized by behavior, and then down underneath the contribution margin are our fixed costs, and we've got fixed manufacturing overhead and fixed operating expenses. Okay, so our, our contribution margin is $213,500. My fixed manufacturing overhead is $18,000. That's right from here. From there, we also had it up above. And our fixed operating expenses are $6,200. Where is it? Right there. There's our budgeted fixed operating expenses. So operating income on a variable cost basis is $189,300. Okay, now let's look at absorption. All right, and just remember, make sure you can do this without looking at anything. Don't look at the solution and then do it. You've got to get this seriously in your memory, okay? So it's really there. So these are all the variable costs, manufacturing plus operating. Okay, and then beneath the contribution margin are all of the costs that are fixed. So it's manufacturing overhead and operating. Okay, so on an absorption basis, our sales would be the same. So $335,500. And then we're going to have a new format here, these 3 lines. This is different than the way it was done before. I need to see this on an exam problem because I'm looking for this fixed manufacturing overhead volume variance. So don't twirl around with this and give me something different. Do it this way. My unadjusted cost of goods sold is 61,000 units times $1.80 per unit. That's the fully absorbed cost, right? Okay, so 61,000 times $1.80, that's 109,800. My volume variance then was $600, and we figured it out right there by $600, and it's unfavorable. Okay, and the reason it's unfavorable is because we pushed through, we didn't get enough units completed. Okay, so we're going to put volume variance down here, and that would be an increase in expense. It's unfavorable, so it increases cost of goods sold expense. So then the adjusted cost of goods sold is $110,400. Okay. Then 335 minus the 110 is 225. Then look at it and check your math and make sure you went in the right directions. Subtract variable operating expense and fixed operating expense. These are period costs. Okay, on an absorption basis, all the operating expense is down here beneath the gross margin. So operating income is $188,400. So now what we want to do is reconcile this. Okay, reconcile the two. Here's my variable operating income was $189,300 from here. Okay, $189,300. Now we've got a change in inventory was actually 3,000 units. We started the period out with 5,000 units, and that's right over here. Okay, we started it with 5,000 units, and we end up with 2,000 units, and that's from this calculation. So there's my beginning inventory. I produced 58,000, so we've got 63,000 available. Minus sales of 61 gives us an ending inventory of 2,000. So that's a net change in inventory of 3,000 units at 30 cents a piece is $900. Okay, that's the change in inventory, and that brings us down to absorption income. And the reason why it's decreased is because we've released more units from inventory than we put into it. We had 5,000 in there, now we've just got 2,000. So we took out some of the beginning inventory, okay, which all had pieces of fixed overhead attached to it. Okay, so I hope this is helpful. Make sure that you can do this one on your own. It's a nice clean problem with no surprises and no tricks. Okay.